Welcome. Thank you for joining us for today's MDM Webcast, the 2018 Mid-Year Economic Update. Our 60-minute program is sponsored by Oracle NetSuite. My name is Tom Gale, CEO of Modern Distribution Management and website, mdm.com. I have the pleasure of moderating today's program. The story halfway through 2018 is momentum and a few headwinds. First quarter results for publicly traded distributors were strong. Grainger sales were up 9% in the first quarter. Same for MSC. HD Supply was up 14% in their first quarter. Fastenal up 13%, and Lawson Products also up 13% in their first quarter. Monthly reports for May were also largely double-digit increases. Likewise, privately held distributors have been reporting similar results, a better than first half than the flatter, more turbulent cycles of the past several years. But, and there's always a but when we're talking about economic cycles, most economic indicators are pointing to a moderating second half, and our speaker today will share the data and his views on that. Brian Lewandowski is the lead author and analyst for the 2018 Economic Benchmarks for Wholesale Distribution, and a valued research partner and resource for MDM Analytics for many years now. He's an associate director at the Business Research Division of the Leeds School of Business at the University of Colorado Boulder. He is a Leeds MBA and has worked at CU Boulder since 2006, working on economic forecasts, econometric models, and market research and real estate studies. Brian has a background in banking, international development, mining, and tourism, working for Fortune 500 companies. Brian, welcome.
Thank you.
Before we get started, a few brief housekeeping notes. If you'd like to access the handouts for today's program, please go to mdm.com/slides and download them now. You'll see that at the top of your slide now on the screen. Or email us at info@mdm.com and we'll send them to you as a PDF attachment. Our program is being recorded today, and we'll be sending a follow-up link to this recording to share it with your colleagues or listen to it again. I encourage questions today, but in the interest of time, we won't be taking questions by phone. Please use the chat function in the bottom left of your screen to ask a question at any time, or if you're experiencing any technical issues. Simply type your question at the very bottom left there, hit the Enter key. Finally, you can make the slides larger and view our presentation in full screen mode by clicking the button in the top right of your screen that says Full Screen. You can return to the normal size by hitting your Escape key. So let's get started. For more than a decade, Modern Distribution Management has produced an economic forecast as part of our Webcast programming schedule. Each year, in addition to the macroeconomic outlook you'll hear shortly, we've also provided a first look at our annual report, just released a few weeks ago in partnership with Oracle NetSuite. The report is published by MDM in conjunction with the Business Research Division of the Leeds School of Business at the University of Colorado Boulder. Brian has been the lead analyst and author of this report for 8 years now. In a moment, he'll give us a snapshot of how distributors performed in 2017, as well as our forecast for 2018 and 2019 for each of the sectors of the $5.7 trillion wholesale distribution industry in the United States. The 2018 Economic Benchmarks for Wholesale Distribution is a comprehensive economic reference guide broken out by 19 major sectors and each with deeper subsector analysis. For example, the industrial subsector itself has 19 subsectors. Each sector and subsector report includes detailed data for 2017, revenues, number of companies, branches, average sales by company, branch, and employee, as well as average gross margin where it is available. Now let me turn it over to Brian to outline what he'll be talking about today. Welcome, Brian.
Great. Thanks again, Tom. I can't believe we've been working on this together for the last 8 years already. So my presentation today, I'm going to start by doing an economic outlook, reflecting on the data at this point in the year. And as I go through the presentation, I'm going to relate it back to the wholesale trade industry and also talk about some risks that we see on the horizon. But just so you know, as we're creating this book, we're really using a lot of publicly available data from sources like the Bureau of Labor Statistics and the Bureau of Economic Analysis and the U.S. Census Bureau, and also correlating that with things like the ISM indices to really try and come up with a good forecast by sector. So the Wholesale Distribution Economic Trends Report does provide revenue, inventory, employment, and other metrics on the 19 industry sectors that Tom mentioned a few moments ago. This slide here is in order by revenue, with pharmaceutical wholesalers being the largest sector in 2017 in terms of revenue, and furniture and home furnishings the smallest sector in 2017. But what you can see here is growth by sector for 2017 in nominal terms. That's where it says actual revenues. And then in real terms, where we've actually adjusted growth for price increases. And I think what stands out here is that 17 of the 19 sectors grew in nominal dollars in 2017. There were still 2 that got a little bit smaller. But when we convert that to real dollars, adjusting for the price changes, we actually had 4 sectors that declined. But overall, 2017 ended up being a really good year for the industry. The industry grew revenue by about 7%. This beat our expectations from a year ago. In real terms, the industry grew by 3%. But that nominal increase of 7% was largely driven by price changes. So if you take a look at the third row, we can see that the oil and gas products wholesale distributors grew 23%. And most of that was price, with the price recovery. In real terms, the industry only grew 0.6%. Another large increase came in metal service centers, grew 16%, but adjusting for price, it grew 3.5%. So that 7% is good, but it's also important to remember real growth, taking out those price changes. And in real terms, the industry grew 3% in 2017. One thing we watch is the revisions that the industry has, and even from March until June this year, we saw the 2017 estimates from the Census Bureau get revised down, and they were revised down by about 1.4%. And that amounted to about $30 billion in downward revisions, and that can make forecasting the industry difficult. But what's nice is we're able to update these estimates throughout the year. So a few months ago, we were forecasting growth for 2018 and 2019 that got revised down modestly because of the softer 2017 growth. We should note that more than half of the industry is represented in 5 subsectors. So 5 subsectors represent over 53% of industry revenue, and those same 5 subsectors represent over a third of industry employment. So it's these first 5 in the list: pharmaceuticals, grocery and food service, oil and gas, electrical and electronics, and motor vehicles and motor vehicle parts. Those are the behemoths of the wholesale trade industry. I think it's also interesting that these are primarily small businesses. Over 80% of the industry employment is in firms that have 20 or fewer employees. So what's our outlook for next year? Overall, we're projecting revenue growth of 5.2% in 2018, and we're projecting a little bit slower growth, still positive in 2019. We're looking at about 2.9% right now. We're forecasting that all but 2 sectors will grow in nominal dollars in 2018, and all but 1 will grow in 2019. And then the greatest growth in 2018 we're expecting to be in the oil and gas industry. One thing we look at is the correlation between wholesale trade and GDP. And you can see how these 2 track over time. Since 2009, the correlation is about 0.9. A perfect correlation would be 1. This makes sense, as the 2 are really a reflection of each other. Wholesale is a conduit for business-to-business activity and also for business-to-consumer activity. And as we know, 67% of our economy is consumption, so the road to the consumer is through wholesale distributors. So expectations for the national economy closely represent expectations for wholesale trade at large. And we do expect national economic growth to be fairly strong in 2018 for the rest of the year and 2019, so I think that bodes well for the industry overall. But I think it's also important to note that there's great variation among the individual wholesale trade sectors. So the correlation is 0.91 for hardware, plumbing, and heating when we correlate that to GDP. But when we correlate agriculture to GDP, for instance, it's minus 0.2. And oil and gas is only 0.1 correlated with GDP. So we're not simply correlating each sector to GDP to create our forecast. We have different indicators that we use to forecast each individual subsector for wholesale trade, and we do a bottoms-up forecast. So really our total forecast for the industry is a summation of the 19 subsectors for wholesale trade. Indeed, with continued GDP growth for 2018 and 2019, we project continued wholesale trade growth. But looking back in 2015 and 2016, this wasn't the case. In 2015, the industry shrank by 4.9%, and that was due primarily to decreasing commodity prices. As I mentioned, with oil and gas and agriculture, those are our two industries that are highly susceptible to wild price fluctuations, and that can cause wholesale trade overall to grow or to shrink. So we look at the industry overall, and we also look at the core industry, which removes oil and gas and agriculture. And what we saw in 2015 and 2016 when we removed those components, the core industry did grow. Wholesale distribution did decline for those 2 years, and as I've already mentioned, the industry grew strongly in 2017, again because of these two volatile industries. We've had 5 very strong quarters of consecutive growth. We're talking about 7.5% growth in Q1 of 2017, followed by 6.1% and 6% and 8.6% and 6.5%. So we're seeing not just moments of growth, but we're seeing sustained multiple consecutive quarters of growth. And even aside from the commodity price growth that we saw in those two industries that I mentioned, the core industry still grew 4.2%, 5.4, 5.1, 7.6, 5.7. So there's this pattern of strong growth even aside from some of the price increases that we've seen. You can see up here that we are projecting out continued growth in 18 and 19 in those yellow bars, but you may also notice that it's sloping downwards. So we're increasing at a decreasing rate, and as I mentioned on the prior slide, we're expecting 5.2% growth in 2018 and 2019. Of course, these growth projections don't come without exception. Growth can be derailed depending on what happens in our overall economy, and I'm going to touch on a few of those things now. So this chart is showing you GDP growth over the last 3 decades. And what we saw during the 1990s is we had about 3.4% growth. You remember the boom times of the late 1990s. This is really a tech boom that came crashing down in the early 2000s. So we went from an average of 3.4% to an average of 1.7% growth in the 2000s. So we had this recession in 2000. We also had the Great Recession in 2007 to 2009, which definitely decimated overall growth. And in fact, when we take a look at the GDP gap during the recession and following the recession, we were below growth potential for so long that we basically missed out on about $6.4 trillion worth of economic growth. And now we're in the 2010s. We were averaging about 2.2% growth. Over the last 4 quarters, we've had 3.1%, 3.2, 2.1, 2.2. The expectation is that we're going to get close to 3% this year. There's one publication that I subscribe to. It's called Consensus Forecasts, and it takes a look at 25 forecasting agencies and their expectations for the economy. So we can see the variation in expectations. But the average among those groups is 2.8% for 2018. I think that these estimates are getting bumped up right now. We'll get close to 3%. We might hit 3%. But we're not seeing really aggressive growth where we expect to break out to a sustained rate of, say, 4% anytime soon. And this is even with things like the Tax Cuts and Jobs Act and the budget that was passed earlier this year, where those things are helping us get to 3%, but not much over that. Looking out a little bit further, it's outside the projection period for this project, but the expectations get a little bit darker. Moody's, for instance, has U.S. economic growth under 1% in 2020. So I think it's this expectation that at some point we'll enter another economic cycle, and I'll talk about that in just a moment. So the components of GDP growth, we have consumption, investment, government spending, and net exports. I've broken out growth in this 4-quadrant slide here. Consumption is about 67% of our economy. And what you can see on this slide is that we've had really strong growth in personal consumption expenditures starting in about 2013 or 2014. Even when other components of GDP have not been strong. So we've gone through this period for about the last 5 years where the consumer's been carrying the economy. It's really the consumer's been responsible for most of the economic growth that we've had. But what's good when looking at this slide, for instance, when we focus on fixed business investment, we're getting help from some of these other components. So looking back, over a year ago, fixed business investment was flat or negative for many quarters. And now we've seen 4 of the last 5 quarters above 6% growth for fixed business investment. And in fact, Q1 of 2018 came in at 9.2%. So that's certainly an area that's adding some fuel to our economy. Government spending went through about 6 consecutive quarters of growth under 1% or even negative, and now we're seeing a little bit of help from government spending, and we expect that to be a little bit larger in the rest of 2018 with some infrastructure and defense spending. And then exports. We went through this period where we actually had decreasing goods exports. Now we're seeing some growing goods exports, but we're also seeing growing goods imports. Some good news came in Q1 of 2018. We actually saw that trade deficit get a little bit lower. It improved a little bit. Our goods exports grew at a little faster rate than our imports. So thinking just briefly about business cycles, what we have up here is all of the business cycles post-World War II. And I'm sure many of you have heard this by now, but we are on the cusp of our longest economic expansion post-World War II in this country. And if we take a look over these last 9 or 11 cycles that we have here, the longest expansion was in the 1990s. We grew for 10 consecutive years. So that's the longest U.S. expansion. The shortest expansion was in the early 80s. We had growth for about a year, and then we slipped back into a recession. But when you take a look at expansions on average over time, they're about 5 years. Right now, we are 9 years into an expansion. And June of next year, we'll tie the record for the expansion. I think one way that we've sustained such a long growth period is that we had so much capacity coming out of the recession. There was so much slack in our economy. There were so many unemployed people. Factory production was down so much that it took a long time to recoup this. So we've been on the slow growth path for a while, but now things are starting to tighten up a little bit, and I think that's why there's some of these dismal expectations when we look out 2 years or further, that another cycle will happen at some point and some of these constraints will perhaps get us there. When we take a look at employment growth, I think this slide really illustrates the recession well. What we see in the gray bars are the actual recessions in 2001 and 2007 to 2009. And you can see how recessions destroy jobs. So during that Great Recession, there were months where we were actually losing about 800,000 jobs per month in this country. And it wasn't until 2010 where we actually started to sustain job growth again. And it was fairly modest. It was 88,000 jobs per month nationally. This rate of job growth accelerated until 2014 when we were growing about 250,000 jobs per month on average. And then this pace of growth started to decline. So you can kind of see it in this 3-month moving average, a slight deceleration there. And so I think really coming out of the recession, as I mentioned a moment ago, we had real demand side issues leading to our slow economic growth. So the demand side issues were creating labor problems where we had too many people chasing too few jobs. We had this excess plant capacity because there wasn't demand for that plant. And now it's flipped a little bit where we're seeing real supply side issues. And I think one example of this is truly the labor market. Almost universally around the country, we're hearing complaints from businesses about shortage of labor, shortage of skilled labor. So continuing on this thread of the labor markets, initial claims and continuing claims, we're in this extremely low period of unemployment claims. So for initial claims, you have to look back to the late 1960s. For continuing claims, you have to take a look back to the early 1970s to see the rate of continuing claims and initial claims that we're seeing today. And what you have to remember here too is that we're a much bigger market now than we were in the 60s and 70s. We have way more people in our labor force, much larger population. So if we normalize it for the size of the economy, this is even a lower number. So this is a really positive sign for employees and for the consumer. And I think this relates to when you hear about the unemployment rate. So the U3 unemployment rate is this traditional rate that we hear about when we talk about unemployment. It's down to 3.8%. This is below our 30-year average. When we talk about the labor utilization rate, which takes a look and accounts for discouraged workers, underemployed workers, people who are working part-time but want to be working full-time, even this is below our 30-year average, and it's down to 7.6%. This number got over 17% during the recession. The unemployment rate got over 10% during the recession. So this is a good signal for that absorption of slack in the labor markets and in the economy. I think that you'd be hard-pressed to find someone who would say we're not at full employment right now. I think all indications are that we are at full employment right now. And one thing we expect when we're at full employment is that firms start competing for workers, and a really good mechanism for competing for labor is through prices. Pay people more. And we are in fact now seeing some real wage growth. So over the last 3 months, year-over-year wages grew 2.8%, 2.9%, 3.3%. data from the Bureau of Labor Statistics. You can also look at an employment cost index, which takes a look at a basket of employees over time, kind of like the consumer price index, and that's showing real wage growth too. And the other interesting thing here on the labor market thread is the labor force participation rate. So this is a percentage of people in the labor force 16 and over divided by your population 16 and over. And what we saw is that participation peaked in 2000. This was something structural within our economy. We had baby boomers that were starting to age out of the workforce. And this comes after a long growth period where from 1950 to 2000, we saw the female participation rate in this country almost double. And interestingly, when you take a look at the male participation rate over that period, it was on a slow and steady decline. But nonetheless, in 2000, we saw the overall participation rate start to fall. And then during the recession in 2008, you can see how this line got steeper. The decline got steeper, and that was because the recession perpetuated job losses and this participation rate decline. You know, people maybe wanted a job for a while. They were showing up on the unemployment rolls, and then they just dropped out of the labor force altogether. The expectation was, with demographics in this country, we expected this to continue to decline into the early 2020s, when in fact it looks like it turned the corner in about 2016, and it's at least stabilized, and it's actually trending slightly upward. I think that this can be a sign of the tight labor market. Perhaps people who needed to be retrained, maybe their skills were a little bit obsolete, maybe they were a little bit older and were having a hard time getting hired back into the market. Maybe employers in a tight labor market said, all right, we're going to compromise on some of this stuff. Back in 2009, we could look at 200 applications for a position. Now we're getting 10. So that's causing some opportunities that maybe weren't there before for some of those people. Plus, with the wage growth, it can be more enticing for people to reenter the labor market. So it's a good thing that we see this participation rate turning. Household wealth also is at record levels. I think one thing to note here is that overall household wealth doesn't adjust for inflation over time. We could do that. But it also doesn't account for wealth imbalances. So who owns the real estate and who owns the stocks and the bonds. But regardless, household wealth is at record levels. We're pushing about $120 trillion right now. The Dow Jones Industrial Average is up 19% year over year alone. The NASDAQ is up 24%, and it's at record levels. The S&P 500 has increased over 300% since hitting the trough in March of 2009 during the recession. So, I mean, this is an important signal because consumers are seeing their wealth grow in general, and all of this ends up helping buoy consumer confidence. So I've demonstrated that employment, income, and wealth have all recovered and are continuing to be positive. The labor market's much more stable. Debt remains cheap in this country. Consumers are taking on more revolving credit. There's less uncertainty in the economy. Consumers are feeling better, and when they feel better about the outlook, they're comfortable parting with their dollars and spending more. And so that's why we expect consumption to continue to grow over the next 2 years. So now we're going to turn and look at a couple of industries. Starting with taking a look at manufacturing in general. So the ISM Manufacturing Index is a good metric for us to watch. It's a good barometer for the manufacturing industry. And then ISM also does a non-manufacturing index. So both of these are barometers, and if the number is over 50, then it points to an industry expansion. If it's under 50, it points to an industry contraction. And what we can see is both of these metrics are pretty strongly positive right now. So good barometer saying that things are pointing in the right direction. Likewise, when we take a look at industrial production, very positive at levels that we haven't seen over the last few decades. When we take a look at capacity utilization, we also see that increasing. It's not at peak levels, which shows that there's still some slack out there. It shows that it's not a troubling constraint right now, but it's increasing. And then when we take a look at employment by industry, this is a good barometer for which industries are doing well, which are growing the fastest. So mining and logging is one that we're seeing grow at the fastest pace right now. It's far from the largest industry, so these are small jobs numbers on, large jobs numbers on a small base, but it's resulting in over 8% growth year over year. This has to do with the rebound in the oil and gas industry. So mining, it's a little ambiguous, but it's the extraction industry. So it could be gold, it could be coal, it could be molybdenum, it can be oil and gas. That's all included in this sector. Construction is also growing at a fast pace, growing about 4% year over year. But if you scroll all the way down, wholesale trade, still positive growth. It's not quite 2% growth, but it's positive. We only have one industry that's losing jobs year over year nationally, and it's the information sector. So information includes things like the traditional publishing industry. So think about newspapers and magazines. It also includes software publishing and broadcasting. And that's an area that's been on just a long-term structural decline. When we take a look at vehicle sales and retail sales, vehicle sales peaked in 2016 at 17.5 million units. The consensus forecasts projections for vehicle sales is it's about 17 million units here in 2018 and 16.8 million units in 2019. So we're seeing this slow down a little bit. This was expected as people had delayed purchases during the recession. We kind of caught up post-recession, and we're seeing this slow down. And I'm sure many of you have heard that the average age of cars on the road is now pushing 12 years. Vehicle quality has gotten better. They're lasting longer. And I think it'll be interesting to watch vehicle sales over the longer term. I'm talking 5 to 10 years out to see what happens with things like driverless vehicles and the sharing economy, to see how consumers actually own vehicles different from my generation and past generations. Retail sales continue to show strong growth. But we also know that this is an industry that's going through this period of disruption right now. So if we take a look at the number of retail establishments nationally, this number actually dropped in 2017. So we saw fewer establishments in 2016 than we saw in 2017 than we saw in 2016. E-commerce grew 15.2% year over year in Q1 of 2018. That compares to growth of 5.2% for retail overall. So we see traditional retail growing, we see e-commerce growing, but we're seeing e-commerce grow at a much faster rate, and it's gobbling up more and more market share. So e-commerce is now about 9% of sales nationally. But I think one thing to note here is that from the consumer standpoint, consumption's about the same. We're still consuming this basket of goods and services, but the mode and how we're purchasing it is changing. And so I think it's important for us to watch the old bricks and mortar stores and see how they adapt to this changing e-commerce environment. So the headlines show what's happening to Sears or happening to Macy's or happening to Sports Authorities and other large legacy retailers that we grew up with, but we're seeing stability among a lot, in fact, among the bulk of retailers, and I think it points to those retailers adapting to this new environment. Home prices, we're seeing strong growth almost universally across the country. The gray states here are showing the slowest growth, or between 0 and 2.5%. But the dark gold, or the brown states on this slide, are showing between 10 and 13.5% growth. So Washington, Idaho, and Nevada are showing the strongest price growth year over year, according to the Federal Housing Finance Agency index. You can generally see the color differentiation on this slide, that the fastest growth is happening in the West and the South right now. We're seeing a shortage of housing, a shortage of construction, and strong demand for housing, and that's leading to these price increases. So what is the residential construction market doing? You can see on this slide, this is from 2000 to 2018, there's that buildup during the recession. We hit almost 12 months of supply in the housing industry, which is pretty unprecedented. And so we overbuilt nationally, and builders backed off. Many of them went out of business, some of them consolidated, and we saw the market correct. So, and even overshoot to where we were underproducing housing for many years. And now, starting in 2013, we started to build that back up. But our housing supply is still pointing to a shortage of housing generally. What type of housing are we building? This was kind of interesting coming out of the recession. Nationally, we really built up multifamily housing. And now we're seeing that back off a little bit, where we're seeing it shift a little bit back towards single-family housing. It was in 2015 when we were almost 50-50 multifamily and single-family. And now we're at about 37 or 38% multifamily housing overall. The long-term average for building permits is 1.5 million units. We're looking at about 1.2, 1.3 million units in 2018 and 2019. One of the constraints out there, one of the supply side constraints, is construction labor. We know there's a shortage of construction labor in this country. We're actually still below the 2005 to 2008 levels for construction workers in this country. Turning to the energy industry, this slide is showing crude oil storage, and I think it represents well the paradigm change that we saw in this country when it comes to oil production. So our inventories nationally from 1982 to about 2011, 2012 were pretty stable. And this includes imports and our own production. And this slide excludes the strategic petroleum reserves. But if you take a look at the tail end of this slide, in about 2013, 2014, there was a large spike in crude oil storage, and to the point that we didn't have any place to store any more oil. The U.S. has become the largest producer of hydrocarbons in the world. We're close to being the largest oil producer in the world, and this really reflects a change in technology. So fracking and horizontal drilling, we've been able to tap resources that were never imagined as far as the possibility to tap these 15, 20 years ago. So, so we're certainly an oil producing country now. Our production depends a lot on price, and this is one of the most price volatile industries that we have. Taking a look at a shorter history from 2014 to 2018, in June of 2014, we reached $103 a barrel. This is the WTI spot price. And you can see how quickly that dropped. And then it stabilized in the $40 to $50 range for a couple of years. And now we're back up in the $60 to $70 range for oil prices. And what does that mean? It means that as prices are higher, it makes projects more feasible for the oil exploration, drilling, and extraction companies. So we see greater investment on the part of oil producers. And one metric for us to track when it comes to this is taking a look at the Baker Hughes rotary rig count nationally. So what I've done here is I've shown gas rigs, oil rigs, and the WTI spot price. And you can see the relationship on this slide between price and the drilling rig count. One thing to point out here, though, is a decade ago, we had about 80% of our drilling rigs devoted to natural gas exploration. In 2018, we have over 80% of the rigs devoted to oil exploration. So while the industry has come back, it's really flipped as far as what we are producing. Natural gas prices have stayed pretty suppressed for the last 6 or 8 years, and that's holding back natural gas, where oil is really benefiting from technology and price. So what are some of the risks to wrap this up? I think one risk that we have is that we're having broad employment growth, broad economic growth in this country, but even though most states are growing in terms of employment, they're all growing in terms of GDP, it does vary widely from state to state. So the gray states on this slide are the slowest growth states. Of course, there's 2 states, Alaska and North Dakota, that are losing jobs year over year. The darker gold states are the ones that are growing the fastest. And so you can see that these are out west and in the south. If you even zoom in further to the metropolitan statistical areas, you'll see that these areas have grown even faster. So this rural and urban split in economic growth has been pretty apparent. So I think one risk here is that we have these submarkets that have grown well and now they're overheating. So we've got unemployment rates in some of these markets that are below 3%, even below 2%. We've got housing constraints, job constraints in many of these markets. So if we've kind of cherry-picked our growth, if we've extracted slack out of these really appealing markets, then we're presumably going to rely on some of these softer markets in the upper Midwest for some of our growth because they have the capacity over the next couple of years. So I think the disparity in growth is something that we need to watch because it's a little bit of a risk. I think interest rates are a little bit of a risk, even though we're still well below our long-term average. It's just not a place that we've been in a while to have these higher interest rates, and they've come up pretty quickly. The Fed sets the short-term interest rate, and they're not setting long-term mortgage rates or even long-term treasury rates, but these correlate, and the short-term rate impacts the long-term rate. So think about what this means for mortgages. If we take a look at a 1 percentage point increase in mortgage rates, or 1.5%, like what we've seen over the last year and a half, this equates to about a 12 or 13% increase in being able to service a mortgage. So to illustrate this, if you're buying a $300,000 house a year ago and mortgaging $300,000, and you're mortgaging the same $300,000 today, that monthly payment is going to be about 12 or 13% more expensive. You layer on top of that home price appreciation, which has gone up 10% in many markets nationally, and couple that with the interest rate increase, and that same house that you were looking at a year ago that was $300,000 is now $330,000, and now the interest rate's 1 to 1.5% higher. So servicing that mortgage on that house would then be about 20 to 25% more expensive. So that's how we look at it when we think about how rising interest rates can slow down the housing market. We look at delinquencies by loan type, And most of these are remaining pretty stable, but we're seeing some higher delinquencies in credit card debt. We're seeing some higher delinquencies in auto loans. You've probably read about some of the subprime auto loan problems that have crept up. So this is something that I think is a risk for us to watch, as is inflation. So inflation and core inflation are now over 2%. We're seeing continued growth in the shelter component of inflation. So that's the gray shaded area here. This reflects the increase in home price appreciation and also the increase in rents nationally. The troubling thing with inflation is prices in most markets have gone up faster than wages in most markets over the last 5 years. So consumers from that standpoint may not be better off over time, but now we're seeing wages start to keep pace with inflation. I think the federal budget balance is also a risk, and I'll tell you why. I mean, we've seen larger deficits in the past, but when we saw the larger deficits, they were during the Great Recession. So we used this Keynesian stimulus model to try and inject economic activity into the market to get the U.S. economy going again. Now we're injecting government stimulus in terms of the increased spending or through the tax cuts. We're injecting this into the market during a period where we're having sustained economic growth and we have little capacity in the market. So how much stimulus does the economy need right now, and what tools does it leave for the federal government and for the Fed to address our next business cycle? And that's why I think this is a risk, as well as our debt to GDP ratio as this carries on to long-term debt. And then lastly here, trade. I think that we have a pretty strong dollar right now. I think the risk when it comes to trade, even though we have growing goods exports right now, is what happens with trade policy. And we've seen the White House talk about renegotiating NAFTA, renegotiating or putting tariffs on many of our goods imports. And I think this introduces uncertainty. We're not really sure how it's going to impact the overall market, but we are sure that it imposes uncertainty in the market. And so we're watching this to see how it impacts goods production and then ultimately the end consumer. So just really in closing, what we see is that the economy is reaccelerating nationally. It's doing better this year than it was doing last year, and expectations are that 2018 will be the best growth year for GDP out of the last 5. Employment growth continues to be strong. We're seeing strong balance sheets on the part of households, which is really good for consumption. We're seeing good global trade, but I think there's this worry, as I just mentioned, about trade wars and renegotiating trade agreements. And strong value of the dollar is certainly helping out. And then there's the risk of rising interest rates and what this means for consumption overall and investment. Rising energy prices are helping producers or making projects more feasible, but it's also impacting consumers in their pocketbooks. They're spending more on fuel than they were a year ago. And then, of course, inflation and how that's impacting individuals and how their incomes are keeping up. So, Tom, that is the end of my spiel. Do we have any questions?
Well, thank you, Brian. As always, a really nice job in the way that you articulate a lot of pretty complex moving parts right now. So we do have some time for questions, and as a reminder, you can ask a question by typing it into the chat window in the lower left corner of your webcast window, and then you can hit the return key. And let's get to the first one here. How is the gig economy affecting the employment rates?
Yeah, that's a really good question. So we can see that some individuals working in the gig economy may not even be counted when it comes to the covered employment numbers that the Bureau of Labor Statistics report each month. So if I'm working for myself as a sole proprietor and taking on multiple different jobs, I'm not reported in that monthly employment release where the BLS reports that the U.S. added 220,000 jobs last month or whatever the number is. But if I'm working for multiple individuals, multiple companies as a gig employee, I could also be being double counted. So it's kind of an interesting dynamic there. I think what's hard about the gig economy is oftentimes those positions don't come with benefits. So if you're a sole proprietor working on multiple different projects for yourself, you're footing the bill for not only medical care and dental care, but also things like retirement, and I think that can sometimes put individuals in a riskier position than they were in prior decades. But overall, I think it's ingenious on the part of employers and employees, or they're individuals responding to a market need, and it's certainly providing opportunity for millions of people nationally.
Yeah, Brian. And another question here. I know in some of your work you've been plugged in with the different mining sectors, and particularly here in Colorado and elsewhere. But with the lack of infrastructure and skilled labor to process steel and aluminum and the impact of the tariffs, how do you see the tariffs mentioned will impact the manufacturing sectors and operations in terms of the additional cost to source and produce, either in government spending, consumer spending? Will the mining industry see some growth again out of the kind of the shifts that are taking place now, do you think?
Yeah, I mean, that's the theory, right? And I think at this point it is a little bit theoretical because we haven't seen how it's actually going to play out. The tariffs on steel and aluminum, I think the last I read was that some of our largest steel partners are exempted from the tariffs. So, how much of a price impact, how much of a supply disruption impact will it have? It may be modest, but, of course, if we have to produce that more domestically, then it's an opportunity for the steel industry to grow, and it also should lead to higher prices for those inputs, which will impact many of the manufacturing sectors that relate to the wholesale sectors that we talked about here. But I think it's really too early to put too much emphasis on it as far as the concerns. I think so much of this is going to still change in the next 9 months that I wouldn't lose a whole lot of sleep over it.
So let me then, that kind of opens it up for me to ask you a little bit more crystal ball questions here. And one is, it sounded like the story that you provided is the rest of 2018. I mean, we gave the forecast. Can you just talk a little bit in terms of what you see happening over Q3, Q4, and where you see the year ending up? And then farther down the road, you said that 2019 was going to be still positive growth, but this is moderating. I mean, do you see another recession? I know asking an economist this question is not a fruitful endeavor usually, but does it happen 2021, or are things lining up to kind of combine here?
Yeah, so I do see another recession, just because I don't think we've figured out how to engineer our way out of having these business cycles. In fact, if you take a look back to the late 80s and then the late 90s, that was the talk when we had these really long expansions that, hey, the Fed has figured it out. We're done with recessions, but they still happen because we have this virtuous cycle where during expansions, firms have this incentive to produce as much as they can, as quickly as they can, and then our economy overheats, and we go through downward cycle, which is the recession. So it'll certainly happen again. I think it's always hard to predict when it'll happen. But what we're reading is that the Tax Cuts Act is having this stimulus effect in 2018, and it'll still have some effect in 2019, but it'll actually start to be a drag on the economy in 2020 as the Congressional Budget Office has demonstrated this in their literature, as have many economists. So the theory then is that it becomes a drag as the stimulus kind of goes away, and as you impose some sort of new stimulus, then it ends up slowing you down if you're not injecting something new. So that's one source of the slowdown in 2020. And then the other source is we're at full employment. Where do we find any more workers? So we compete on price, and then we see faster wage growth, and these things can't really sustain themselves, so we naturally see a tightening in the markets and a slowdown. And so what the models show is this slowdown kind of starts in 2019, possible recession then maybe in 2020, 2021. But I think that anyone's guess at that point is fair right now. We don't know what will even cause the next recession. It could be these tight labor markets. It could be interest rates. But if you take a look over the last 5 recessions, we had a financial recession, a tech bubble burst. We had a savings and loan crisis. We had an oil crisis. And so all of these things were different. And they weren't necessarily apparent when we were on the doorstep of the recession. So, I mean, there could be so many factors that we're not even paying close attention to that could cause the next recession. So I think aside from those caveats, the U.S. economy is primed for strong growth in 2018, strong-ish growth in 2019, and then keep an eye on 2020 for a real slowdown.
If I read the slides that you had and put together a few of the pieces, we really had a hot fourth quarter in 2017, and the first quarter of 2018, certainly in industrial sectors, has been really powerful. It sounds like there's a little bit of potential moderating in consumer. So we're coming down off of a plateau here or a peak and start to moderate here as we get towards the end of the year. Did I interpret that correctly?
Yeah. What you should all expect is that the Q2 number is going to be really stellar. I mean, we're talking maybe 4% growth in Q2, and then some more moderate growth in Q3 and Q4 of this year. But we should get close to 3% for the overall year.
Great. So, based on that, do you have a recommendation or thoughts, based on the previous cycles that you've seen? Is there a particular way for a distribution leader to position a business here at this point of the cycle? It sounds like we still got, this year is going to be very solid, a little bit less solid next year, but it sounds like things start to sort of move downhill based on all the current indicators. Any thoughts in terms of the right way to start thinking about positioning at this point in the cycle?
Yeah, I think one thing I note when I pull this data for you every year is that all of the individual subsectors are so different, and their growth patterns can be so different, and they can be cyclical with the economy or they can be counter-cyclical. So I think it's hard to really prescribe any sort of general rule of thumb for people in the industry because of all of the nuanced differences within the subsectors. But one easy barometer for all of you to pay attention to are these leading economic indicators. So there are these indices that the Philadelphia Fed puts out, or Goldman Sachs or Wells Fargo. I mean, many institutions have created these leading indicators. And what's nice about them is they are a single barometer for the economy. So they're taking a look at the economic metrics that lead economic cycles and economic metrics that lag economic cycles. And so the leading indicators, this index is really helpful for getting in a single number how the economy is doing. And they're pretty good at predicting recessions, maybe a quarter out or maybe 2 quarters out. So that's one thing I would recommend, is taking a look at these LEIs to get just a sense of the barometric pressure of the economy.
And Brian, I think that's probably the best answer to that leading question that I've heard, in terms of there is no one right answer. This industry is so fragmented that it really does depend on the specific sector. And with that, let's end with that question. And again, thank you for a great job as always. I hope our program has proved helpful to you today. And I'd also like to thank Oracle NetSuite for its sponsorship of this program today, as well as its strong support for research and educational programming on key wholesale distribution trends. We'll send a link to access a recording of this program. Please feel free to share with your colleagues, and thank you for joining us today. This concludes our program.